Hello guys, and welcome back to another video. This is Daniel with Leyyon Investments. We're an alternative investment firm, and today what I want to do is bring you a stock that I believe has some good upside potential in the long term. So this stock I would recommend for someone who is looking to invest now, hold for 6 months to a year to possibly even more. A stock that I've identified as a good buying opportunity for a long-term hold is PayPal Holdings. PayPal Holdings has been on a downtrend since the ending of 2021, as we can see here on the chart. We'll take a look at the ending of 2021, and that's where it broke its support, where it topped around 306 as its all-time high. And during this downtrend, there were price gaps. And if you're familiar with price gaps are, well, if you aren't familiar with price gaps are basically when the previous candle closes at a certain price and then it opens at another price that is not the price where it closed at. In general, that's what it is. But you could also take a look at the high and the low of the candlestick to identify that price gap. Here we have a price gap of around $222 a share, another one at $149, $150 a share, and a smaller one over here at $107. Currently, PayPal is trading at $74.65, where we see a support level of around $66 per share. I want to get into some of the news that has been coming out on PayPal. So let's move to that. Recently, PayPal has extended a partnership agreement through 2026 with the Phoenix Suns. So this can be very good for PayPal in the long term, as it maintains its partnership agreement with Phoenix Suns. Currently, we'll take a look at the PE ratio for PayPal. The PE ratio is the price of the stock compared to the earnings of the company, and that is currently sitting at 35, where it's neither considered to be an overvalued metric. I tend to like PE ratio, of like 15 to 25, but this is sitting around that range. Previously, PayPal Holdings was around, if I recall correctly, around 100, some maybe even greater than 100 at the time where it was at its all-time high, where the stock was overvalued compared to the earnings of the company. So in my recommendation for this long-term hold is that one would buy, and of course this is not investment advice, but merely a trade idea. So currently I would like to hold the January 17th, 2025 80 calls. So this is a call option with a strike of 80 that expires January 17th of the year 2025. So what exactly is this for those that don't understand stock options? So when you buy a stock option, when you buy a call option, you basically have the right but not the obligation to buy shares at a certain specified price known as the strike price by a certain time in the future known as the expiration date. So for example, the current spot price or the current price for PayPal is $74.77. And if I buy a call option with the price of with the strike price of 80, that means I'm willing to buy PayPal stock at 80 sometime in the near future. So why would this benefit me? Why would I want to buy PayPal stock at 80 when it's at 74? Well, one reason is that I have a bullish sentiment on the stock. So if I own a contract that allows me to buy shares at 80 when sometime in the future the stock may be at 140, I can exercise my call option to buy 100 shares of PayPal stock at 80 when the price is at 140. And so that's a $60 gain per share, where I can there immediately sell it in the open market for 140 when I had bought it at 80. Now, that's one way that you can do it. Another way that you can profit on this trade is by selling the call option to someone else and capitalizing on the premium. So the premium is basically the cost of the option contract. So for example, if I buy the 80 strike call option when the price is at 74, the current asking price for this call option is currently at 1.6, so $16 per call option. And since there are 100 shares of stock, you multiply that price by 100, 16 by 100, and you get the cost for that call option, which is about $1,600. So when the price of the stock increases, now the premium of the call option increases as well, because it's more likely to be profitable. Well, not more likely to be profitable, but more likely for this stock to be valuable, for this contract to be valuable for someone who wants to buy PayPal shares at 80 sometime in the future. So that's a metric. That's another method of profiting on this trade. Now, another method is to buy shares, to buy 100 shares of stock at this price, and as the stock price increases, you can sell call options to mitigate your risk. So what happens when you sell a call option? Essentially, you have 100 shares of stock and you sell a call option. With this combination, you are forming something what's called a covered call. So if we go back to what is a call option, you're giving the right, if you buy a call option, you have the right but not the obligation to purchase shares at a certain price in the future, known as a strike price, by a certain date, known as the expiration date. Now, if you sell a call option, you're selling the right to someone else to buy XYZ stock, or in this case, PayPal stock, at, for example, if the strike price is 80, you're giving them the right to buy PayPal stock at 80 by some time in the future. And since this contract expires in 2025, you're giving them the right to buy PayPal shares at 80 when by sometime before the year 2025. So in the case that you sell this call option, you're receiving a premium because they bought this call option from you. So you're selling a call option to them and they pay you, let's say, $1,600, right? Let's go with that number for this call option. And you have longed 100 shares of PayPal stock. And for example, let's say the price did go up to 120 and you think that the price is going to retrace back down to support, and later on continue its uptrend. You can sell the call option at 120, and as the price decreases, they won't exercise the option. You sold it. Excuse me. Yeah, you sold the call option at 120, right? So they have technically the right to buy PayPal shares at 120. when the stock is now, let's say the stock does go down in your favor, right? It goes down to 100, right? 104. They won't necessarily exercise this option, because why would they exercise the option agreement with you to buy your shares at 120 or 140 when the current market price is 104? So essentially, they can sell that option contract to someone else, or if that option contract expires worthless, you keep the premium of the stock of what the option contract was when you sold it to them. So that's $1,600. So what does that do? It hedges your position, and reduces your not loss, because you're profitable in this trade since you bought shares at 74. But instead of losing, let's say 4,000 from your gains, you basically only lose 2,400, because you received a premium, a credit, or payment for that stock option, for that call option that you sold. So I hope that helps you explain 3 ways on how you can profit on this trade with PayPal. One is buying a call option. You can buy an option contract with a long expiration date, and as PayPal increases over time, you just capitalize on the premium. Or you can exercise to buy 100 shares of stock at 80. And the stock that you would be buying from, you buy it from the person who sold you that option contract, essentially. Another way would be to buy the shares and sell calls, forming a covered call spread. So I hope this video was informative. I'll be making more of these videos to show you, some good stocks that I believe that are good for the long term, that you can swing trade either to the upside or the downside. PayPal is one of them. And in the next video, I'll be covering another stock. Thank you for watching, and if you have any questions, feel free to comment or contact me at the number that you see on the screen. Have a good rest of your day. How do I